Hey everybody, Real Estate Ninja here. I hope you're doing well. I want to talk to you about a story out of Yahoo, and this is honestly the truth. The journalist is extremely disconnected from reality, and I want to explain why. But it's that other side that gets taught to people, and they have no concept of reality, and they teach it to people that have no concept of economics, the real estate markets. All right, so. Without further ado, I'm going to read it and then we're going to chat about it, okay? It's out of Yahoo. I'm going to link it below. It's entitled Mortgage Rates Just Dipped and Home Prices May Have Reached the Peak, which we already know we passed the peak, guys. We've already passed the peak, okay? Can't make this stuff up. But buyers are hoping for a free fall will be disappointed. All right, so that's the title. Mortgage rates just dipped and home prices may be reaching the peak. So it says they haven't even hit the peak yet. But buyers are hoping for a free fall, but they will be disappointed. It says, after climbing above 7% for the first time in 20 years, U.S. mortgage rates, 20%, are they high? I haven't even read this story yet, I'm gonna be honest with you. Okay, they are high. Let me give you an example. 2006, 2007, a mortgage rate was 7% in America. That's not 20 years. Wow. Now, 20 years ago would be 2002, and actually that's not true because in 2001 mortgage rates were 7%. Okay, so obviously right off the bat that is not true. Go check a chart, guys. That's not the case. Okay, so right there, first off the bat. U.S. mortgage rates moved back down this week, even as the housing market continues to reel from high borrowing costs. Rates also dipped despite the Federal Reserve announcing another hike of 3/4 of a point to its trend-setting federal funds rate, a sign that inflation is refusing to be tamed. Now, that's true. Inflation is refusing to be tamed because the Federal Reserve is not raising rates fast enough and high enough. And I want to explain something too about that 10-year bond, which really does influence the mortgage. There's other rates that can influence mortgage rates depending on the type of bank and their policy. But the 10-year did not jump up exponentially when they announced the rate hike because it was already priced in, okay? So the bond market had already priced that in. We all knew that it was going up 3/4 of one, well, not 3/4, 75 basis points, right? 3/4 of 1%. So that's that, okay? The real upward pressure of the 10-year bond is coming because of central banks announcing they're selling T-bills to prop up their currencies like Japan, all right? China also. The big selling has not even started yet. You're gonna see that and you're gonna be blown away. So it says here, it seems that mortgage rates have already priced in some of the effects of the Fed's higher interest rates. Now guys, you're literally watching me read this story in real time. I saw the headline, I knew the story was wrong. So, okay, so I already said it, right? I apologize. But I don't pre-read this stuff. I never do. A lot of people don't know that about me, actually. I go through this and I give my narrative as we're talking about it, okay? Now, this is coming from Nadia Evangelou, senior economist for the National Association of Realtors. So cool, we're on the same page. That is correct. The bonds did not raise, the mortgages did not raise because the 10-year bond was not affected by that rate hike everybody knew was coming. Yet, depending on how quickly or slowly consumer prices and the still frothy job market, I love how they use frothy. They can't that job market sucks right now. It's all a lie. You're gonna find out it's a lie, like what's going on in Canada right now. Begins to moderate, the rates for home loans could soon start ticking up again. All right, that's true. They are going to continue to go higher. I love, at least this journalist is interviewing someone that knows what they're talking about. Now here's some bullet points. The average home insurance policy is nearly 40% higher than it was 12 years ago. Here's how to spend less. So these are some of them are, advertisements, right? But that's true, 40% more over the last 12 years. Why? Because building costs, inflation, all kinds of a myriad of things have caused prices to go up, right? It says right here, 30-year fixed mortgage rates. They start talking about this. The interest rate on the 30-year fixed mortgage rate, America's most popular home loan, averaged 6.95% this week, down from 7.08%. 1 week earlier, housing finance giant Freddie Mac reported on Thursday. Last year at this time, the 30-year fixed rate was 3.09%. Isn't that amazing? And over doubling. Now, the cool thing is I called this in December and I said we're going to see 8% mortgages in a year, by that next January, this coming one. And I still believe that to be true. Unless there's some massive intervention by the central bank, which there should not be. They want those higher rates to take down the market. You're going to see 8%. But we've already seen an over doubling. And it did happen a lot faster than I expected, I will say that. At today's rate, the monthly mortgage payment on a median priced home is $965 higher than it was a year ago. The dramatic jump in financing costs has effectively shrunk most buyers' budgets. Now, 15-year mortgage rates, check this out. The rate on a 15-year mortgage averaged 6.29% this week, down from 6.36 last week, and 2.35%, that's what it was a year ago. So almost a tripling. That's impressive. That is darn impressive. Sales are falling and prices in many markets are following suit. Average home prices are declining in more than a third of the 100 largest U.S. housing markets, according to research from Florida Atlantic University and Florida International University. The markets with the highest drops are primarily in places that had been experiencing the strongest appreciation, like San Jose, Austin, Texas, San Francisco, Boise, Idaho, and Salt Lake City. Now that is how all real estate corrections happen. They all start in the places that were the biggest bubbles. They pop and then they affect the outlying areas and then they cross over across the country. It says housing markets across the country are definitely slowing down and appear to be reaching the peaks of their current housing cycles. Now, check this out. This is where it gets very interesting. And I wanted you to understand, we're going to go through this and I'm going to explain something about how these journalists do something, and it's dirty. They talk about the 5-year adjustable rate mortgage. Right now, the average rate on the 5-year adjustable is 5.96% this week. Last year at this time, 5-year on ARM was 2.54, okay? So 2.54, remember it said the 30-year fix back then was 3.07 or something like that. So it was not worth it. It was literally almost the exact same price to get a 5-1 ARM, right? Now, a 5-1 ARM, that spread has spread out, and there's a more dramatic difference of over 1%. All right, so think about this, well over 1% difference. So it's forcing people to 5-1 ARMs, just like what happened in 2005, 2004, all right? Because the Federal Reserve is raising rates. You can't make this up. This is history repeating itself, and this should get you excited for a real estate crash, and a real one, okay? So it said ARMs start out with fixed interest rates and typically last between 3 and 10 years, right? So 5-1 is right in the middle. There's 3 years, 5 years, 7-1 ARMs, and there's 10-1 ARMs, okay? So here we go. The Federal Reserve's impact on mortgage rates. It says the Federal Reserve does not set mortgage rates, but the Fed funds rate influences a range of borrowing costs, including those on home loans. And I'm just going to break it down real easy. The bank borrows money from the Federal Reserve at a certain percentage. They mark it up a little bit and they loan it to you. That spread, that difference between the mortgage rate and what they borrow it for at the Fed funds rate is their profit. All right, so that's how it works, very simply. We're going to go through that. Then it talks about where will rates go from here. Mortgage rates could climb 8% or more by the end of this year, early into next year, should inflation prove to be stubborn. We all know that that's going to come, right? So check this out. Mortgage applications, it talks about falling, and I'm just going through this for time-wise. For the 6th straight week, talks about how mortgage applications are declining very rapidly, but it's way more than 6 weeks. I know there was a spur of mortgage buying in September, and those were some people that are literally having some very serious problems financially. I talked to a loan broker, and it was people that needed cash out to pay bills, all right, because of inflation. Very serious stuff. So there was a flurry of rates, refis, and some purchases, and then diving down again, all right? So people are being laid off right now like crazy in droves. So check this out. It talks about the elevated rates continue to put pressure on both purchase and refinance activity and have added to ongoing affordability challenges impacting the broader housing markets, as seen in the deteriorating trends in housing starts and home sales. Now check this out. Here's the end of the article. This is the most important part. If you stayed till this is the meat of this entire video. What to read next. It's trying to get you into these other articles like cash is trash. Why do you buy a house before 2022? Now check this out. We're going to go back to the title. Mortgage rates just dipped and home prices may be reaching the peak. So it's they have the ability to go up higher. But Buyers hoping for a free fall will be disappointed. Nowhere in that article does the journalist say why buyers are going to be disappointed because there's not a free fall. You see, what happened was the journalist just wanted you to get to click on that story, and I want you to take a look at the story if you want, because there's all these hyperlinks in there to get you to buy things. The journalist is a complete con person. And this is by Nancy Sharnoff of MoneyWise. You're a con woman. All you're trying to do is get people to click on it so that they can click on something else. Nowhere in this entire article did you say that there's not going to be a free fall. And the reason why is because your entire article proves that there's going to be a free fall. The Federal Reserve has not stopped raising rates. Rates are going to get higher. Inflation is going to get worse. Mortgage applications are going to continue on the downfall. You should be ashamed of yourself using clickbait just to try and get people. I use clickbait to try and get people to show them the truth. You just lied just in the title. Lied, not you. Why don't you just do this? I can't believe mortgage rates just did this. And then Nancy, do one of these faces. Oh, that's some real solid clickbait because you're just going to lead them to the truth, facts. But you lied to them. Homes hit the peak a while ago. They're already turning down. We're not waiting for them to hit the peak. And guess what? There's going to be a free fall. Guys, you're all going to crush it. I can't wait to watch you crush it and buying homes from the banks because of so many people that read insane articles like this and can't tell heads or tails from the real estate market. All right, guys, that being said, I thank you so much for watching. The Real Estate Ninja is out.